Is this recent market turbulence a reason to panic or a golden opportunity? We're talking about buying the dip in quality stocks that have strong long-term future. If you're new here, my name is Nick. I am the co-author of an award-winning book, The Quick Start Guide to Investing. And at 42, I quit my job, I moved my family to sunny Spain, and we live off a small dividend portfolio and weekly options trades. This is not financial advice. If you want a overpaid suit jockey to tell you to buy the Mag 7, go for it. This channel is just where I share my experience and my findings and hopefully provide a little entertainment and knowledge along the way. Today, we're going to dive into 5 companies that have seen some recent stock price pressure, but possess strong fundamental growth drivers. We're looking at Robinhood, we're looking at Netflix, Meta, UnitedHealth, and my favorite, Costco. So stick around and let's find out if these should be long-term portfolio ads for me. Welcome to 15 Minute Money, the show where I search the financial world for the most up-to-date investment ideas, market trends, and income streams so you don't have to. I'm your host, Nick Bradley. Let's get into it. We're probably going to be familiar with all these companies. So we're going to peek at recent news, we're going to check the charts, and then see why it might be a buy the dip opportunity. But before we get too far, do me a solid, hit that like button, and before you forget, hit subscribe if you want more sarcastic stock information. Thanks a lot. Number 1. Robinhood, ticker symbol HOOD. If you don't know, Robinhood is a commissions-free brokerage platform. It's trying to revolutionize the retail investing, especially for younger demographics. It offers trading in stocks, ETFs, options, and crypto. Hood has had a solid Q3 performance. They have $1.27 billion in revenue, which beat estimates, and transaction-based revenue surging 125%. Cryptocurrency and options and equity trading are also boosting. And then again, there's the push towards Gen Z opening retirement accounts at younger ages. Let's check the charts. So as we can see, Hood, like my last, there's a couple of videos ago where I was talking about Hood buying at the 100-day moving average or it possibly falling in to fill this earnings gap. Check the charts. I feel actually pretty good about this one. It did in fact fall down to this gap post earnings. It bounced a little bit lower, got down to 102, and then took off from there. Today, Thanksgiving Day. Happy Thanksgiving, everybody. Trading at $128 per share. I called that one perfectly. I can't even say it worked well. The TA is magic if you do it right. Did I wait long enough? No, I didn't. I did a cash secured put on Robinhood and I got assigned about 115. So it's looking good now, but for a while I felt a little stupid by not listening to my own advice. So I think here is a good spot for Robinhood, but let's look at the Bollinger Bands because that typically helps figure out what's going on. So let's look at the Bollinger Bands. When we add those to the chart, let's get rid of my box here. The Bollinger Bands, we are, as you can see, it bounced off of that area there around 102, and it's currently in the middle, so I think it's a pretty decent opportunity. If you're looking to buy the dip, which I'm not specifically because I got assigned 2 cash secure puts earlier, and I have 1 cash secure put in the 90s, which looks like I'm not going to get assigned, so I just have my 200 shares, but buying the dip, it's a decent opportunity looking at both the bounce where it hit from as well as it's sitting in the middle of the Bollinger Bands. But this also provides a decent cash secured put opportunity if you want to go out into December. You could sell the cash secured put at the bottom of the Bollinger Band in the 102s, maybe even at the top of this red candle at 120. You never know what's going to happen, but that seems like a good long-term dollar cost average. The charts say it's a good buy, but why buy the dip? Well, despite volatility, Robinhood's future lies in its ability to monetize massive Gen Z boosts. Currently, most of the people, 26.8 million users, are young. It's appealing to Gen Z. And guess what? As these people grow into retirement and they receive money from their parents and their grandparents, Gen Z isn't going to go to Fidelity. They're not going to Schwab. Hood is most likely going to be the long-term winner with this new generation. So if you're looking long-term, I think Hood wins. Next up, we're talking about Netflix. Everybody knows Netflix, the dominant global streaming service responsible for changing how you've swapped cable for other things. It's the reason why you have too many platforms. The company recently completed a 10-for-1 stock split, which if you've seen some information before, I like to wait for after the split. It normally has about a 5 or 10% drop, and now we're seeing that. You also have the ad-supported tier, and in their Q3 earnings, it says it was the best quarter for their ads. So you used to be able to just buy Netflix and not have any ads. Now you've got a more expensive Netflix or a cheaper Netflix with ads, and those ads are making Netflix a lot of money. So let's check the charts. Looking at the Bollinger Bands here, it is at the bottom of the Bollinger Band. Looks like it found a little bit of support around the 103 post-halving, and they're down about 10% off the split. So it's a good buying opportunity. It works almost every time. Every time a company has a split, you see a sell the news thing from long-term holders, and then it falls 8, 5, 10% sometimes, and then that's a good buying opportunity. It's already back up. It's down 9% since the split and still 30% from all-time highs. I think it's a good long-term buy here if you think Netflix is going to be continuing to win, which I think they do. Netflix, even in recessions, has proven to be fairly recession-proof. So I like Netflix, but why buy the dip? Well, they're maintaining a powerful economic moat. And thanks to its brand recognition, everybody knows them. And network effect, they're winning all sorts of things. They've got a great library. They're getting data on your habits. They're making you watch shows that you don't even think you want to watch. And then the ad tier is making them a lot of money. So even with the recession possibly coming, I think Netflix continues to win. So for me, I did dollar cost into Netflix using a cash secure put. I got assigned last week, and I got assigned at 108 per share. So I've got 100 shares of Netflix. So I used the cash secure put to dollar cost my way into Netflix, but I don't think it's too late if you want to join the train. Obviously not financial advice, but I like Netflix for my long-term portfolio. All right, coming in at number 3, let's talk about Meta platforms. Meta, M-E-T-A, which is also Facebook and Instagram. Obviously you know about the company. They own Facebook, they own Instagram, they own WhatsApp, and they own Reality Labs. So that's what the metaverse focus is. But its core business is huge. You want to think that they are like this, I don't know, social media platform. They're not. They are in the business of big data, and they are putting tons of money into AI. And why are they doing that? Because they can use our resources to train their AI models. Whether you think it's happening or not, I think it probably is happening. Recent news, you've got shares recently saw volatility after Q3 earnings because they continued to say they're spending tons on AI, and investors weren't sure if they like that. So Meta definitely saw a bit of a fall. Let's look into the charts and see how far Meta fell. I don't have any position in Meta at the moment, and it looks like they're scooping up from the bottom of these Bollinger Bands. After earnings, you saw this huge earnings gap. What was just that right there? From there to there, it had a 10% fall after earnings. It didn't stop from there. It came all the way down to 22.5%, 22% off of the earnings fall. They've now come back up a bit, but from earnings, you're still looking at a 14% discount as we head into Friday. Let's talk about why buy the dip in general. Well, the company just won a major antitrust battle where the judge rejected FTC's argument to force them to try to get rid of Instagram or WhatsApp. So the recent dip, tied with the high capital expenditure plans, is probably being viewed as a long-term investment in the next major technological boost. They're looking at AI. Meta's pouring billions into AI infrastructure. And I think we all know that AI is going to change companies. It's going to be a big time future profits booking area, and it's going to help Meta both get our data and make more money off of us. So you may not like that as a user, but you probably like them making more money in the long run as an investor. So as an investor, I think Meta is a good buy here. I'm going to probably dollar cost average into some shares here for my retirement account. Next up, we got UnitedHealth Group, UNH. It's the largest health insurer in America and operates in 2 major segments. You've got UnitedHealthcare, which is the insurance, and then Optum, which is health services, which includes pharmacy benefits and technology. Recent news, the stock has been under pressure due to an unexpected spike in medical care ratio, which is MCR. And that means they had more claims than they thought they were going to have. So that was a mouthful. Let's check the charts. Looking at the charts, you've obviously got UNH way back here in April, had a huge fall from over $600 per share. They had a big gap down to 482. Then they fell some more to 377. Then they had a gap down to 305. Now, at this point, it was announced that Warren Buffett and Berkshire Hathaway had been buying the dip. They started buying up here into the high threes, and then they continued buying around. It was announced, well, I think they were $305 per share when it was announced that Warren started buying. So you got a little bit of a push, some more fall up, and then you saw some price movement up. At this point, everybody's thinking, oh, Warren bought, we're off to the races. Things are going great. They gapped up after earnings, but now you're seeing them come back into the Bollinger Bands. You're seeing them find some support back at the 305 level, exactly where Warren Buffett bought it, and now trading at 329. So is it the best buy ever? I don't know. It's certainly not going to perform like some of the high tech stocks. If you think you're going to be seeing 20, 30, 40% a year from UNH, I don't want to disappoint you, but I don't think you'll see that. Will you see possibly market beating returns from this point? Probably. So I think UNH, if you don't mind investing in a healthcare company, which I think does the American public a disservice, but it doesn't seem like the current administration or possibly the next administration is going to change anything about healthcare in America. So UNH is probably a good long-term buy here. Why buy the dip? Well, UNH offers exposure to a massive, growing, and relatively defensive healthcare sector. So if you're worried about stocks being in a bubble, UNH provides a little bit of diversified play there. As well as, I don't think that the healthcare market's going to change anywhere. It's recession-proof, it's resistant, and it's shown that even though this declines, it does seem to be a good buy for the long term. I haven't made my mind up on UNH. I'm not sure if I'm going to be a buyer here, but the charts do indicate it's probably a good buy. Warren Buffett bought in the mid threes. It's in the low threes now. So are you really going to argue with one of the greatest of all time? Maybe. I seem to be saying that on every video. He bought Google. I like Google. He bought UNH. We'll see. All right, let's finish up with my favorite, Costco. Ticker symbol COST. If you don't know about Costco, you're living under a rock. They are the dominant warehouse in the game. You might be going to Sam's Club. If you go to Sam's Club, I'm sorry. You need to be in the Costco game. I kind of go to both, but Costco is my love. I'm waiting desperately for them to open a Costco here in southern Spain. It was supposed to be open last year, and now it looks like it's getting pushed to 2027. Costco, please ditch these Spanish bozos you're using to work with. I will tell you where to build, and we can get this thing done in a couple days. All right, so Costco has fallen a bit in terms of the stock, and I think it's showing a little bit of, it's not weakness, but it's going to give you a buy the dip opportunity. They've had a pullback despite reporting solid sales, and they've got growing membership income, and the membership is pure profit. If you don't know, Costco works on a 15% margins. So the price that they can buy products for, they add 15%, and the members know they're getting a good deal. So members pay money on an annual basis to be able to shop at Costco, and then Costco makes 15% on its competition products, not its Kirkland products. They might make a little bit more on the Kirkland. But the company is continuing to expand. I just said they're planning to come to southern Spain. They plan to open 35 new stores next year. So let's check the charts. Costco. Got some old lines from an old video here. Costco was in the thousands. What do we see? They're high at 1,076, and they are kind of stuck in this channel still. You can extend this channel here. Extend it here. They haven't touched it lately, but dang, down into the 870s. If they kind of got into this channel, they poked below the Bollinger Band here. Then they've popped back up into the 9s. What does the daily moving average look like? So we have the 100 in yellow, which is below that, and it's below the 200-day moving average. Historically, buying stocks under the 200-day moving average has provided some volatility in the short term, but it seems to have been a good buy in the long term. Can we even go back far enough on Costco? Yeah, it doesn't, a lot of the tech stocks kind of bounce off of these moving averages. You see some bounces here back in last year and some years before, but kind of dipping below. I can't think that the economy is in such a toilet that Costco is going to be in trouble. Some of their bigger ticket items might fall a little bit, but I think if we can dip into the mid 800s, if it could touch this channel again at 853, I'm definitely going to be a buyer. I started buying Costco at 500. I bought some more around 700. I think my average cost is in the 6s. If it gets down to this channel here at 850, I'm going to be a buyer again. So I'm going to set an alert for Costco to see if it falls into the 850, see if I can get a better price. So why buy the dip? Costco does have a sticky business model. Its membership income is pure profit, and they are exceptionally reliable. They've got 93% renewal rates in US and in Canada, making them less sensitive to economic slow turns, because I don't care what's going on with the recession, I'm still buying at Costco because I love them and I think that I'm getting a good deal when I go in there. All right, those were the 5 stocks that I think are good buy the dip. I'll give you one quick bonus before we go. I'm looking at Nvidia. Who isn't, right? It's the biggest company in the world, but Nvidia is touching, actually fell below the 100-day moving average. If it can get down to the 200-day at 153, I think we've got a great buy. If it dips into the 60s again, right here at this level of support, 164, I'm going to sell a cash secured put to buy 100 shares at 150, 153. So we're looking at possibly getting Nvidia from an all-time high of 211. If you could scoop it up at 155, you'd be looking at 26, almost 27% off the biggest company in the world. So Nvidia is on my watch list if it falls to the 200-day moving average at 155 and change. Guys, thanks a lot for sticking around. I do these videos every single week to tell you what I'm doing to stay away from my 9-to-5 job. If you found this helpful, hit the thumbs up and subscribe, and we'll see you next week. Thanks for joining me today on 15-Minute Money, the show where I search the financial world for the most up-to-date investment ideas, market trends, and income streams so you don't have to. I'm your host, Nick Bradley. We'll see you next week.